Okay, I think we are live on YouTube. Let me make sure this doesn't come on and start yelling at me. Got it. All right, you boys ready?
Let it go.
Yep.
Let's go.
Go.
Welcome, everybody, to this week's edition of the Not Your Average Investor Show. Just in time for a very, very prescient discussion around what is happening in the markets. Markets have dropped 10% across the board or more. S&P's dropped 11% last weekend. NASDAQ down 20%, worst since the Great Recession and pandemic. Dow is down 2,000 points for the fourth time in history in one day. The market lost a record $6.6 trillion in 2 days last week. But us here on the Not Your Average Investor Show, we're hearing all these things. We're hearing the winds of recession coming. And as real estate investors, we beg the question, how does this affect real estate investors? I'm your host, Pablo Gonzalez. GC is not with us here today because he took the magical journey down to San Antonio to watch the Florida Gators win a national championship. So instead, we've invited two of our community members, a couple of guys with a ton of experience across the board doing this. To my right, I guess it's my left, when I look at it on the screen, is he is a former IT professional who at some point decided he wanted to build a real estate portfolio in order to insulate himself from having to move and do the things, and in 2019 decided to go full-time into real estate investing. My ride-along partner on the bus at the last summit, Jay Corup. Welcome, Jay.
Hello. Hello,
And
everyone.
then to my right, we have the man with no H in his name. The H is silent, folks, who I famously mispronounced it for a very, very long time. Reformed Wall Street analyst, now full-time real estate investor himself, the pride of New Jersey these days, Hervé Francois. Welcome to the show.
Always a pleasure, man. Thanks for having me on. Great.
Good to have you too. Good to have you too. And gentlemen, we do the intros and then we got a little tradition around here. You guys know what we start with here?
You know what it's called.
Yeah, roll call.
The roll call, baby, the roll call. We got leadoff hitter John Hannon kicking us off today. We got the early bird in the house checking in second, Dean Curry. We got Jeff Pettijohn from Missouri checking in. Suzanne Parker saying hello, everybody. We got LinkedIn Lowry, Ed Lowry saying greetings all. Chris Lee from Fernandina Beach is back as well. Tony D is in the house. We don't get Tony D very often these days, Hervé. He's got to be a friend of yours or something like that. Anthony Dida. We got the Maven from the mountains of Denver checking in. Alex Diaz from Tampa. Alex, good to see you again. Met you at the summit. Linda Evans is here. Good to have you. We got the man who's rocking in Rockland, the second Steeler fan of the Not Your Average Investor community, Lewis Hudnall. Good to have you. World famous composer John Williams from New York, Long Island. No Mountain Man, Pellegrina, saying hello to all investor snow leopards from the mountain of Colorado. I like that, Billy. We got the luck of the Irish in the house. Kevin O'Brien from Rhode Island. That's up by where you guys live. We got the Shaw Man in the house checking in from the Pacific Northwest. Nadeem Shah. Robin Schofield checking in from New Hampshire. Good to have you. Melrose Joanna checking in. Wind is blowing here in New York, Wall Street. Yes, it is indeed. Who else? Linda Mercurio for checking in from South Carolina. Good to have you, Linda. The Man of Steel, Vincent Barbarite, also from Long Island, I believe. Checking in as well, Justine Herrera, David Vivar, Ternando Rey from Chicago. Ternando, that's definitely a new name. Good to have you, Ternando. Hope you make yourself comfortable here and show up. Amy Roberts, good to see you again. Joyce K from, I think that's a new name as well. Joyce, welcome to the show. Welcome to the show. Normally I have my co-host Greg Cohen with me, but today I got these two esteemed gentlemen. We're just gonna talk about it, guys. Let's get right into it. As on Friday morning, as I'm doing my early morning walk and I start to get the headlines rolling in on my phone and I see this like market cratering, this like thing that's happening out there. My first reaction was, oh my God, I need to go to my Robinhood app, right? Because normally what I'm checking every day is my stock ticker, right? Like I'm real proud of my Nvidia pick from 2 years ago and stuff like that. Not so proud this time around, right? Like I'm seeing it, it's down 29%. I'm like, man, okay, well, I'm in it. I'm in this AI revolution. I want to ride this thing out. But then the next place my head went was like, man, I think this is the moment when we're all going to start to realize the value of being a real estate investor. And I had very much a calm wash over me uh, based on knowing that I'm so heavily invested in this workforce housing. I'm not over invested in the stock market. I would love to just kind of hear from each of you guys on Friday. You're getting this news, this stuff is happening. Jay, why don't we start with you, man? When you start kind of like checking in on this stuff, you were telling me about this like conversation with conversation you had at home. You want to tell us that story?
Sure. Stock market, this is not the first time, actually. It happened in the past when the market crashed and I was sitting in front of my screen and my portfolio was all red, bright red. So my wife walked towards me and she said, "What is this?" I said, "My stock portfolio." She was so upset about that. And at that time, I had a job, and I was also very upset. I didn't know what to do with that. But then this Friday, she came back and she asked me, like, "How's your stocks looking?" So I said, "It's 28% down, but at least it's not all bright red the way she saw in the past." But I said, "I can show you some other portfolio." And I went to my other spreadsheet where I keep track of all my real estate. And I showed her, "Look at my assets, and then my equity didn't dip, my cash flow did dip, everything looks great. Everything is like green and going up." And I showed I have a graph where, I'm most concerned about my bank balance, because I have one account where all my rental income comes in and all the expenses are paid, my mortgages are paid. The only thing I look there is my money growing or going down, and I've never seen since 2016, my account has been going down. So as it goes up, I buy more properties. So at least that was a very good conversation I had with my wife. And, so she ignored the whole stock and I was happy.
Yeah, I bet. I bet, Hervé, yeah, let's talk about this, right? This isn't the first time we've been through something like this. I'll share my experience there too. But Hervé, you're a guy. Last time that stocks dipped like this, I don't know if you were on Wall Street then. I know nowadays you're much more in real estate. Can you kind of tell me your experience?
Yeah, when I did used to work on the street, now this is going back 8 years, and then I was there for 25 years. There was the volatility, right? I mean, some cases was black swan, some of it was policy related, some of it was maybe not a black swan, but just a bad recurring event, and so on and so forth, right? A sector here or a sector that or a sector there would get hit. Sometimes the entire market, would get hit. We were around for the pandemic. I was out of Wall Street back then, but we remember, at that, what happened. And that was a black swan event, right? But I was around, for the tech bubble implosion, the tech bubble crash back in 2001, and whatnot. So, in 2008, the credit recession and so on and so forth, that really negatively impacted a lot of sectors, but specifically real estate as well. So, there are, it's weird that even though you can say you've been there, done that, so that should give you some insight as to how you are going to react. You find a way to react differently every time we see this kind of volatility, right? And I think what was disappointing about this one was it was so violent. It came so quick in a short amount of time, in a short 3 days. And that's when you start questioning, oh my goodness, what should I do? Should I do anything at all? Should I sell here? Should I buy more? Am I catching a falling knife and so on and so forth? So it is with these volatility. We know that the market doesn't like volatility. The market likes to be able to forecast, it likes to see things ahead. And right now, when you see that this kind of volatility, it just discloses that there's a lot of uncertainty, a lot of volatility in the markets, right? But to Jay's point is, this is why over the past 8 years, I've been stressing so much over and over about having a balanced portfolio of whatever exposure you have in the stock market, as well as your real estate holdings, where I was not preaching that when I used to work on Wall Street, where 100% my portfolio was strictly in stocks, right? And similar to Jay, it is so much more comforting and reassuring when you know that you have that balanced portfolio that, okay, I'm experiencing volatility right now in my stocks, taking a look at what I own in my Robinhood app or my Fidelity app and so on and so forth. However, I still have equity here with these rentals. I still have monthly cash flow with these rentals and so on and so forth, right? So it's not as much of a knee-jerk reaction because it is a balanced portfolio. If you're 100% exposed to stocks, I can see how people would be making a knee-jerk reaction, which is what I think we saw ever since last Thursday through today.
Makes a lot of sense, man. As you're talking through it, I'm thinking of I wasn't I was in college during the dot-com bubble, right? Like just getting into college, right? So it didn't really affect me as much. But then the one that really did affect me was the Great Recession, right? So like 6 years into my career, I just started my 401k starting to be like a real number, and all of a sudden it's a 201k, and that was the only thing that I was really exposed to at that time, and not really knowing how to act. For me, it was very different this time around. We're talking about these balanced portfolios. I personally, over the last 5 years as an entrepreneur trying to build my business, made the decision to, oversteer into real estate at the time for the time, right? Because I felt that my the I wanted to get like chips in and working for me in a specific way as soon as I could, post pandemic, low interest rates, all these kinds of like things that were happening. So I did what Greg calls pull forward demand and, started building that real estate portfolio because I know I want to be in the market and wait. And then it's only been the last couple of years where my cash flow economics have really turned on. I've started to build my stock portfolio back up as well. And I think it's for the first time ever, the somewhere between the mix of being in real estate, like seeing the reality of the market and seeing, okay, well, the stock side of it came down 29%. Again, because I have so much of my safe bucket in buy and hold rental properties, my stock bucket is much more exposed to tech and high leverage, high growth things. So it was more hit than some of the other portfolios that have been out there that are better balanced. But at the end of the day, I still looked at my bank account and still saw the rent that had come in from my properties the week prior. I knew that my equity was still in place there. I knew that if I needed to pull money out, I could do it via refinancing without having to like sell something at a loss or something like that. It was a very different feeling for me. I guess I'm curious to know if the two of you can kind of like I just kind of gave you like a snapshot of mine. Ray, you mentioned the word Black Swan. The book Black Swan by Nassim Taleb was really the first time that I started having this theory of if I could put 75 to 80% of my stuff in like something I feel really, really good about that has some good growth and isn't going to take these volatile hits, I could put the other 20% into more like positive exposure to black swans. So that's kind of the portfolio I've built, right? Like I'm like 80% in real estate, 20% in equities. I would love to know you as you came from real estate, kind of like your overall balance of just kind of like what you've built when it comes to real estate and stocks and stuff like that. No numbers, but maybe the kind of like allocation and how you've thought it through of what you mean by diversification.
Yeah, like I said, when I was, up until 8 years ago, when I was on the street, I was 100% my portfolio was in stocks, right? And then when you're working on the street, okay, so your income is coming from your employer, which is a Wall Street employer. You got a 401k plan, a good chance that you have your employer stock in your 401k plan, right? More Wall Street exposure. Then the way that you're getting compensated, not only your salary but potentially a bonus payment, that's going to come to you in a form depending on the company, cash and stock, deferred payment, deferred stock, and so on and so forth. So it was because of the volatility that I had experienced over the years in all the years that I worked on the street. at the time, what all I knew I could do to minimize that volatility is rotate some of my stock exposure either to another stock sector or just to bonds and or cash, right? It was like at any given time, I could be 50-50 stocks and cash. I could be 90% risk on, risk off, risk on 90% stocks, 10% and so on and so forth, right? So my percentage changes were very, very common on my years on the street. But at the end of the day, it was predominantly stocks. Once I got out and I got into real estate, I'm like, hey, here's a way for me to go ahead and minimize my volatility. But the thing is, when I first got into real estate, I was flipping homes. Well, the problem with that, as we know, is that that's a lot of active income. It's very transactional. You only make money once you flip the home and everything, very hands-on business and so on and so forth. So fast forward now 8 years, particularly in this 8 years that I've been with JWB now, it's very, very different. So I still have some of a stock portfolio. And, listen, I'm 8 years older than I was when I had gotten out of, the Wall Street industry. So as I've gotten older, you can argue that my exposure has gotten more conservative. And with that, that's not stocks to bonds as it's been from stocks to real estate. So today, I'm probably 70% real estate, 30% stocks. So when I saw that volatility last Thursday, last Friday, yesterday, even today, I'm like, okay, I'm good, right? I was, before we started today, I was telling you, if I do have people still coming, hey, what do you think? Give me some advice. What would you be doing right now? And everything else like that. I'm looking at a person's age and answering that question. If you're just starting off your career, you're in your 30s, you're in your early 40s or whatnot, I would recommend to you, depending on what your long-term financial plans are, right? It is a bigger answer, but the short answer, around that age bracket, I'm risk on. Granted that you're going to be experiencing some volatility over the next several months, but I would probably still be risk on. So don't be rushing to sell everything that you have in portfolio. You may want to reduce exposure here and there, but not empty out your stock portfolio. But if anything, this volatility has shown us over the past 3 to 4 days, damned if you don't have a balanced exposure with some stocks as well as some real estate, even more so as you get older, as you get closer to retirement, right? And then as you get closer to retirement, you can imagine folks who have 401k plans looking to retire this year, next year, over the next 2 years, and the hit that it's taken, right? They have been risk off or risk de minimis, right, over the past couple of years, right? Whereas people in their 30s and 40s, they could be risk on, right? So it truly depends, but let this volatility let this be some insight as to why you need to have this balanced portfolio.
Yeah, man. I spoke about that on my Facebook Live, this idea of just like how unfair it is to the people that are like within 2 years of retirement or a year of retirement. It's like that's not the majority of the market, but like the effect of that on you right now, to put your life on hold and stuff like that to me is something that I would want to get rid of, like that, the exposure to that happening to me. Jay, before we go too far down that pipe, what does diversity mean to you? How are you diversified?
So, like Hervé said, I also started like that. I mean, being an IT guy, I was heavily in stocks, and that's how my portfolio was bright red. But then I learned about it and I started putting money in, stocks, bonds, and then in different sectors. So if one sector goes down, the other sector is still making money. So I started diversifying my portfolio in stocks and been doing good since then, learned a lot from other financial advisors and then reading, what is out there. So then when I started with real estate, I also learned few stuff during COVID time. People could lose jobs, so they struggled to pay the rents, the eviction was hard. So things like that happen. So then I was thinking, okay, so that means, things could go wrong in real estate as well. So I started buying properties here, low income, people. And I do started, renting out to Section 8. So the advantage with that is basically, even if the tenant is not able to pay, the town pays majority of the rental income. So I have Section 8 tenants for last 3 years. They don't want to leave my property. They are very comfortable there. And I've been paid on time every month, a good cash flow properties. So it's not only diversifying on the stocks, I think diversifying on the real estate also makes sense. And also think about it, we do have vacancies. And if you have a portfolio of real estate, you don't feel that vacancy because, you're making cash flow in some other places, which will cover up your vacancies. Or if, the mortgage payment, our maintenance or turnover expenses, it's all covered by the other properties. If you have only a few of them, you will feel that burn, but if you have a portfolio, like stocks, even if rental portfolio, actually it helps. And that's what I learned. And that's when I decided I do have properties with JWB. I do have 5 doors in Connecticut. Most of them are Section 8. And I love it. And right now, like I said, I was doing fix and flips. I did a lot. So whenever I make money, I go and buy a property for renting. And then now I'm doing new construction. Hopefully that will go fine because, there is a lot of chaos out in the market about what do you call tariffs and everything. But I'm not so worried about it right now because I have a bargaining power. Gave example like, if I want to buy appliances, I say I don't want to buy one, I need it for 31 units. So now they're interested in talking to me. So I have, places where I can negotiate. So still, I'm happy. I'm not so worried. So like stock portfolio, I started diversifying my rental portfolio, which is helping me.
Let's I want to double click on this purchasing power thing in a second. That's something I want to go around the circle with. Real quick, Jay, you're making a really good point of, you know, there's diversification across stocks and bonds and real estate, and then there's also even diversification in real estate. And you're kind of making a point that I know that you have a handful or a bunch of like JWB properties. You also have some Section 8 properties in Connecticut. You're also right now doing some active like new construction. You want to just kind of like give me a little bit more of a picture of that, of your diversification inside the asset class?
Sure. So, like I have 10 properties with JWB, which is
Mhm.
like a no-brainer. I don't have to concentrate anything on that. I do have 5 in Connecticut, and majority of them are Section 8. So, like I said, my cash flow, is diversifying. So right now I have a vacant property with JWB for, I believe 2 months, but I don't feel that, that I have a vacant property because my other properties are filling up that gap, mortgage payment or turnover expenses or my monthly electricity bill or whatever needs to be covering that vacant property. So that helps. And I don't have any other job. I'm doing my real estate stuff. So my expenses are paid through my rental income and also, with my active income. And the other thing is also like I do have investment outside my real estate too. And I tap into, like we were talking about HELOCs and all that. So I have a liability account where after, I retired from my job, I moved everything into an IRA and I have another portfolio with my financial advisor. So he opened a line of credit for me, which is called as liability line of credit. And I can tap into that funds anytime I want. So now with the stock market down, even though the money I'm borrowed and it shows negative, I'm not in a hurry to pay them back. I called my advisor and he said, no, you're okay. Stock prices, they go up and down. So that's fine. I borrowed like $260,000 for my project. And now it shows that, oh, I should be borrowing only 220, but that's okay. He said, I'm fine. So those leverage I take in the other sectors as well. So, yeah, so I have diversification in stocks, I have in real estate. I do have other investments, where I tap into. And also I have HELOC. I'm trying to open HELOCs with my equities, with, whatever I have with JWB too, because I started buying properties in 2016. So I have I mean, those days the interest rate was low, the price of the house was low, so my equity is very good out there.
And time and market, right? Equity's good out there. Hervé, how
Yes.
about you, man? I know that you got a little bit of this, a little bit of that inside of real estate as well. You're like the first guy that kind of taught me the concept of like your properties having baby properties. So I know that you have at least like 5 or 6 out there with JWB, but you have other kind of like deals that you're a part of too, right?
Yeah, exactly. With the investor group that I work, we buy multifamily apartment
Mhm.
complexes and whatnot, and we bought a lot over the years. And so you know, what it may feel Armageddon to some folks out there, the way that this market's been acting over the past week or so, in regards to where's there silver lining, where there could be opportunities, right? And I see some folks in the chat, Drew, talk about, hey, keep on buying. I agree with that right now, right? Particularly, look at where the 10-year was back in January. We were at about 4.7%. Today we're at 4.1, 4.2%, right? So you've had the 10-year come down. If you've been in the midst, if you were thinking about refinancing one of your properties, right, to pull some cash out, could be a nice time to do it, right, in anticipation of rates declining and whatnot. If you're thinking about buying outright, whether it's another home from JWB, again, could be a really, really good time to buy and whatnot, because rates have been coming down. So your cost of capital has been coming down. What we need to keep an eye on, however, is that we never want our residents to get hurt, to be so negatively impacted from what's going on with this administration, that they're losing their jobs, that they're getting cut back in hours and getting cut back in salary and so on and so forth, because we still want that cash flow to come and things like that, right? So I absolutely will continue to be buying real estate. I think, again, cost of capital has been coming down from a single family standpoint, from a multifamily standpoint. So it could be much more attractive, better returns, because your cost of capital is something that we have been waiting for a while, after the rate increases that we had seen last year and things like that. But so I think that is a silver lining in what's going on right now. One of the things that when I used to work on the street, I would always tell, and the stock market was in a malaise. We were in a tough time, right? Even if it wasn't a volatile sell-off like we've seen over the past 3-4 days, even though we were just in a downward trajectory, let's call it a bear market, the way that Andrew talked about bear market in the chat. Even if we were in a bear market and I was talking to clients that were not interested in buying because we're in a bear market, what I would work through them with is, okay, fine, you don't want to buy today, I get it. Let's make a list. Take out a pen and pad, and let's make a list of the sectors and the stocks within those sectors that you would be interested in buying once they hit that particular level, because they're going to get to that level. Mm-hmm. If you loved NVIDIA, 300 points to go, 300 points higher, you're sure as hell going to love it more today, right? But that's the psychology and the mindset that we need to get to. So have a shopper's list ready of what you would like to buy when that stock gets to that particular point, because most likely it's going to get to that point where the so-called bad news in the downward revisions in earnings and ratings is going to already be built into that stock price. It's going to be built into that valuation. That stock would have found a floor, and then from there, it starts to go back up. Not overnight, but slowly go back up, because you got in at the right price, right? So just for anyone that's interested in the market right now, if you sold over the past few days, if you haven't even sold over the past few days, you think that you missed the stock because it had run real hard and real fast on you last year, you have an opportunity now to get back in. Make your shopping list, because you may have an opportunity to get in sooner rather than you thought.
I like it, man. I like it. So it makes me think of a couple of things, right? This idea of how does this feel to a real estate investor? We've been able to cover really well the fact that the panic doesn't feel as panicky, right? Like the floor is higher. I think Denny said it in the Not Your Average Investor chat. Like, these are the days where the whole like risk mitigation of real estate, you start to really, really feel it when there's all this panic in the market and you're holding these hard assets. But now we're also talking about, it's not just that the floor stays high, it's also, there's actually some real advantages to being in our position right now versus in other asset classes. One, like Jay and Hervé, you've pointed out, this idea that you can get lines of credit on the things on the assets and the appreciation that you hold, puts us in a position where we can go out and buy things at a discount when the market is in panic, without having to sell the asset, without having to take a tax hit, take a loss, and then go like put the money back into circulation. These like lines of credit that we're able to get from our assets that we're already holding allows us to buy things without that penalty. and that, whatever asset class you're going into, right? Like do your own research. This is not financial advice, but like it could be like you're saying, Hervé, if you love something at a certain price in the stock market, you can go find that price and get it without having to like sell on the other one. But it's also a really, really good time to buy real estate right now, because you can keep going. And the beginning of this call is just kind of like this idea of, man, let this be the moment that you're like shocked into action of like, if you're not already holding real estate, the next time around that this happens, you want to be holding it. So let's talk about some of those advantages of like moves that we can make. Hervé, you just brought up the idea that rates are going to go down, so it's a good time to buy. Can you explain that? Like, why aren't you saying wait till rates go down and buy?
Well, rates have already started to come down.
Already down.
Yeah.
So rates have already started to come down. So I don't need to wait until June, September, December later this year for rates to go further down. They may, right? I think there's a lot of it is, what's on the come over the next couple of months in regards to the tariffs and everything else like that. What kind of moves is the Fed going to make based off of the policy changes that the administration is going through and everything else like that? If, you have big banks coming out and saying we are at a higher odds of going into recession or into a recession, we'll wind up getting first quarter GDP numbers by the end of this month. Most likely it's going to be in negative territory. If we have negative territory again in the second quarter, that's textbook recession, right? Two straight quarters of GDP decline. So my whole thing is that we're in a spate in a trend of rate declines. We've been waiting for our cost of capital to get cheaper. We've been waiting for rates to decline. We've been trying to pencil it in last year. What we didn't pencil in regards to returns looking attractive. With the real investor group that I work with, the multifamily properties, we're currently in the midst of refinancing two of our properties right now. We started that process 45 days ago. It's going to end up soon. And as such, we're going to wind up getting more higher proceeds than we would have 45 days ago because the rates have come down in the past 45 days. And we didn't lock in. You really can't lock in until a couple of days before closing anyway. So I would agree, if you had been in the market or you were looking to get into the market to buy a single family home, JWB, I would strongly encourage you to do it because the cost of capital has come down, right? These rates have come down and whatnot. And it gives you an opportunity. Listen, I think Jay might have been talking about HELOCs and everything else like that. I think in one of your shows with Greg, Pablo, you guys talked about there's some companies out there that are providing HELOCs on single family rentals. Okay, so those HELOC rates probably have come down a little bit. Opportunity for you if you have built up some nice equity on your JWB home over the past several years, like I'm sure Jay has, like I have. You could take some of that equity out at a low rate, turn around and purchase another JWB home, right? So just using your equity to not to pay down any kind of expenses, but to build up even more, not only your assets, but equity as well, and things like that. So that's an opportunity. And again, it's a silver lining. This is not the way I wanted to see rates come down because of these, policy decisions and so on and so forth. But this is kind of what happens. Is a recession in the woodworks and whatnot? Your guess is as good as mine. I would not want to see it. And again, because I am concerned about, the residents that do rent from us and things like that and how that can really negatively impact them. But for our portfolios and what we do, not being average, great time to go ahead and look into borrowing at potentially cheaper cost of capital to continue to build onto your single family portfolio.
Yeah. Well said, man. Jay, like one of the things that's out there is this idea, tariffs and construction prices and all these different kinds of things. You're in the middle of a new construction build right now, and you had like a non-obvious insight on, you're I won't put words in your mouth, right? But like you told me basically like that you feel like your purchasing power is doing really, really well right now in the new construction side. You want to tell us that story?
Sure. Yeah. So my new construction project is I'm building a community of 32 townhouses. When I bought the property, one of the house existed, which is a historic house. So I rehabbed that house and, I was allowed to make it into two-bedroom apartments. So I have two tenants living there and I'm building 31 new townhouses. So what I've seen is, yeah, I mean, the tariff and all is going on. It's like a chaos in the market. But when I approach vendors, and when I tell them, lumber or appliances or anything, when I say the number 31, they wanted to talk to me. And now I have like, all backup vendors lined up for simple thing like concrete too. They charge like $200 a yard, but I got a deal for $110 a yard, only because, I have a lot of properties coming up. So those buying power is there. So at this point, but nobody knows how tariff is going to hit at this point, but at least it is helping me to negotiate, with the vendors, so that is there. But, I was a little bit concerned about the buyers, because they're also nervous, like, like how it is going to impact. But, I've seen that when the materials goes up, the house prices goes up too. So I reached out to my bank, my lender, where I have taken the construction loan. I said, can you do my appraisal? How much is the bank going to appraise it to? So they just completed the appraisal last Friday. And, so I estimated based on my, comps, and I was basically in the similar ballpark. So I was very happy. The prices have gone up. And, we put a sign out there, even though we didn't start the marketing, full-fledged marketing. We started getting so many phone calls. And then we are getting phone calls from the town, from the zoning department. Our zoning director keeps on calling me. He said, can you put the sign on? Because I'm getting all the phone calls. I've been redirecting, I'm doing marketing. Otherwise, you should start paying me too. So it's a positive thing. People are looking to downsize because there is zero inventory out there. There is nothing available, which helps. So that's what I'm banking on. But when Arve was talking about, the mortgage rates, but so that is helping the buyers. They can, tap into the low mortgage rate. But for investors, I don't want anybody to forget the DSCR loans too, because we discussed in our past shows, for those who doesn't have a W-2 like me, it helps, and the interest rate are much better than the conventional mortgage, So the last one I closed in January, I got it for like 5.25, which is great. So I encourage people to look into DSCR. You can reach out to John Seaborth, good guy. Most of us met him at the summit.
Yeah.
So, so that's positive.
John Seaver gets a lot of shout outs on, he gets a lot of love on this podcast, man. I love it. Man, that the picture that you paint is so interesting to me because at a big scale, first of all, I'm super pumped for you that you have this like need filling the market, right? Like when you hear about tariffs and you hear about recession, you're thinking, oh man, builders are going to stop building. People are going to like stop their construction projects because they're so afraid. But you're getting this positive feedback that we keep talking about. The supply and demand curve is still just not right. They're still undersupplied in the housing market for workforce housing, for starter home housing,
Yes.
these kinds of like assets that JWB cranks out. You're doing in your market as well, and it even works there, and that's awesome. Um, when I think about it on a much smaller scale, which is me, I was having a conversation with my wife on Sunday, just thinking, one of our non-JWB properties, the duplex that we're like house hacking, we're getting a new roof in this week, and we're kind of like, all right, well, we're glad we locked in this like roof in price before tariffs hit, but then we're also thinking about getting storm windows because it doesn't have storm windows yet before hurricane season hits, and we're asking ourselves, should we buy now before these tariffs hit? And the moment that I had was like, wait a minute, like I feel like these like small time vendors, if recession is coming, if all this stuff is happening, they're worried about being able to sell anyways.
Yeah.
Like they're worried about anybody like making purchasing decisions. So our ability to like sit on it for 2 months and then if a recession comes, if interest rates drop, like all these different things that can happen, we're going to have a certain amount of purchasing power of just being willing to cut a check during a hard time, right? So like I feel like that helps. It I don't know. I just have a hard time slicing this and not thinking that by having even me that's only been as recent as like 2021, but like by holding these hard assets, I don't have an advantage. I feel like if inflation goes raging, my rents and my housing prices keeps up. If recession comes, they're going to drop interest rates, which means buyer activity is going to increase, which means my housing prices keep up. If like what else? Like if people lose their jobs, and a recession hits the stock market, I expect it to like drop a certain amount, and I expect to maybe lose rent from somebody at some point on a turn because they can't keep up anymore. But like you said, it just kind of gets covered inside of my portfolio, and I don't feel like I'm taking a giant hit. Like, I don't know, guys. Am I missing something? Like, is there a scenario that either of you guys are really, really worried about that makes you think, like I'm not prepared for this or something like that?
You know, the one of the we're lucky that, for example, all of us being clients of JWB, that if you woke up January 1st of this year and you say, I am in the market to buy my first single family rental from JWB, or second or 10th, whatever it might be, that that JWB and perhaps other providers out there, they have already an inventory of homes to be sold, and then there are new homes that they have to be built. So you fast forward to today, right? Where now we've heard everything about tariffs and how much they're going to implement and so on and so forth and everything else like that. So it has us concerned in regards to what's this going to happen to the price of new builds, right? Now, Jay was just explaining to you how he's able to negotiate some discounts for 31 appliances he needs to buy, and lumber for 31 homes, and roofs for 31, and so on and so forth, right? You might not be at Jay's level where you're buying 31 homes, but you could still be in that market to buy your first single family property from JWB, or your 10th. But maybe you might be concerned about buying anything that they're going to bring to market over the next 2 to 3 months, because those might be priced higher because of the tariffs. So what are you going to do? You're going to dip into what they currently have in inventory, right? Something that's been built over the past 6 to 12 months, right? If you are in the market this year to buy a new car, a brand new car, right? If you have not bought that brand new car yet, I promise you, most likely your thought has shifted. Okay, put the brakes on brand new car, because we know what's going to happen to those. Let me look at the used car market to see what's out there, right? So I'm going to look at the 2024 builds and so on and so forth. I might miss the 2025, definitely not getting the 2026 versions since that come out in late September. So it just is what it is. So luckily we have the used house market and the new house market. We got a used car market. We got a new car market. We're going to be shifting our buying patterns, most likely, because of these tariffs, towards the used house market and the used car market. So that those purchases on the used side look even more attractive because rates have come down. I would be concerned if all we had was a brand new home market and we did not have a used home market. I'd be concerned that the price of those new homes are going to be higher because of tariffs. The price of those new cars are going to be higher because of tariffs. This happened in the pandemic, right? New car market shut down. New car market shut down, right? Now, part of this was the supply chain was in a disaster and everything else like that. Semiconductors couldn't get shipped into cars and so on and so forth. So what happened? Now, this also happened as well. The price of used cars started going through the roof for the first time in history, right? I was in the market for a used car at that time, right? So here's an opportunity to get in and get that used car. Again, even if it's a used house that's 3-4 months old, right? Here's an opportunity for you to get into it now because rates have come down.
I like it. Jay, is there anything, first of all, Hervé, as you're saying all this, I'm like, damn, man, I like to drive my cars for 10 years and my car has 9 years on it. And I keep like being like, no, I'm going to wait one more year to get a car. And now I'm like, dude, I should just buy a car right now. So thank you for that, sir. Jay, is there anything that freaks you out about this market right now and kind of like in what you're holding or whatnot? Is there anything that you're scared of?
Well, the only thing is like, we talked about the recession, when the recession hits, the jobs, I don't want it to go to what we faced during the COVID time, people losing jobs, not being able to pay the rent and all that stuff. Which is, as a landlord, you don't want anybody to be in that situation too, because it's tough to evict a tenant. I mean, it usually happens, even if it is not a pandemic or a recession, people still lose jobs. Like I have a tenant who lost job and without job for like 3 months, and she was not able to pay the rent. So I said, okay, she went ahead with 2 months. But then I said, okay, how can I help her? So I told her to go into a payment plan. The same thing, if she's dragged into the court, they also do the same thing, right? So I worked out with the tenant, and then she went on a payment plan. She could pay whatever she could. And then she's all paid up. Now she has a job. So, but it is not comforting, if you have, a lot of people, a lot of our tenants going through that, then it will hit us. I know that when the recession hits, the cost of everything goes up. People will struggle to pay the rent versus, all their regular needs, because rent is still high. I don't know if there is anything, where the rent might go down, which I think it is unlikely because of the prices of houses are going up, those the rents will go up. But, the only worry I have is, you know, if everything around us, the price goes up and the rent is also high, for our customers, which are tenants, it's going to be tough.
Yeah.
So that's the only thing that bothers me. I am also working on a project which didn't start yet. We're just talking about it to go into the, low income, what do you call it, affordable housing. So I worked as a volunteer for a homeless shelter place, like a soup kitchen. So one of the board directors, she came to know, though I do a lot of stuff in real estate. So she want to partner with me and do something for affordable housing, to help these kind of individuals, where the state, we still get grant from the city to do renovations on those houses. So, and we are trying to tap into that, and then, encourage or help people who are struggling out there, to give them some housing.
Awesome, man.
So
That's cool.
yeah, so basically my only worry is, the jobs, and how the market goes up, on the other stuff.
Yeah, yeah. We definitely don't want recession to go raging and everybody to lose their jobs, right? That's not good for anybody. I also feel I feel like at least in the obviously I'm over it like I'm mostly in the JWB housing stock, right? Like that the idea of where we sit in this market of being in the workforce housing stock where right now my resident that lives there, is living there because it's the best home that they can afford. But if the economy gets worse, the people that are in like more luxury rental homes will then retreat down to the workforce housing stock.
Mhm.
Makes me feel pretty good about being able to fill those homes and the availability of that housing stock. We keep seeing recession. I asked Greg to give us some numbers on recessions, right? Juan Duque asks here in the chat, would you mind sharing your point of view about the impact of current economic environment and measures by the government in Jacksonville real estate and like the local employment market there? So Greg, even though he's out there celebrating a Gator victory, he put this stuff together. The idea that over the last recent recessions, prices have actually gone up in Jacksonville in all but one. You see that during like the 80s, it went up 11%. Savings and loan crisis, it went up 2%. Dot-com boom and bust, it went up 8%. COVID pandemic up 10%, except for, of course, the Great Recession, in which Jack's home prices went down 30%. But of course,
You
that
know,
was caused by, yep.
I would say what's interesting, I'm glad that I feel that Greg is here, even though he's not here. He's here in spirit. But what's great about this chart and the one on the previous page, what stands out about the decline in home prices during the Great Recession back in '08 that you had showed on the other page, this was not rates. This was, and what caused prices to get soft last year in Jacksonville, as well as rents, supply. And Greg talks about it all the time, right? Supply, demand, supply, demand. That was, and it wasn't only Jacksonville that was hit with oversupply back in '08. It was a lot of big cities across the country, right? Because credit was so easy, right? And builders were building like crazy, right? And so supply, supply, supply. I think Greg typically shows a table or a chart in regards to months of inventory out and so on and so forth. So that if anything, I'm keeping on track. Like Jay talks about it, he's not concerned. I'm not concerned as well in regards to what we currently have in our portfolio of JWB. The number one thing I'm going to keep an eye on is the supply of homes coming into Jacksonville, right? We just need to make sure that there's always going to be a net absorption, right, of homes that are being built and everything else like that. And I think after a lot of construction that took place last year, that is going to subside a little bit this year, perhaps even more so, truly, as tariffs start making their way through the housing supply chain, making it more expensive for developers to build homes. Unfortunately, we saw that back in 08. And again, that was tariffs related. Lumber prices up 40%. Developers were like, hey, you know what? I got to put my hammer down. I can't build homes when lumber prices were up 40%, right? We import a lot of our lumber from Canada and so on and so forth, right? So those are that's probably the number one metric that I look for in regards to what has the biggest impact to average sales price of homes in Jacksonville and across the country is that supply number.
I love that. I love that you bring that up, man. That was the other kind of like insulating factor that we didn't talk about is like if builders stop building, at the end of the day, are us holding the assets, it continues to do well, right? Because of lack of supply. I think this chart paints the difference between 2008 and 2025 pretty well, right? Like you said it, months of inventory in 2025 is still at 4.7, which is below the historical average. Months of inventory in 2008 was at 15.9. The percentage of adjustable mortgage loans that were going to balloon are way higher. Jacksonville unemployment is way lower still, right? So it still shows a market that is underemployed still, right? So like there's still more room to like absorb that as well. Foreclosure rates are completely different. The amount of money invested by Wall Street, which is actually a stabilizing factor inside of the homes because they're buy and hold investors, is really, really good too. So the idea that we're going to see a recession really affect Jacksonville in any kind of like order of magnitude close to the 2008 recession for buy and hold investors seems pretty far-fetched as well. Jay, what do you think you were going to say something?
Yeah, well, I've seen it since I started buying properties in Jacksonville since 2016. The amount I paid in 2016 versus what I paid this year, it's totally different. It's basically doubled in price.
Yeah.
And what I see is the changes we saw when we were at the summit, what happening in downtown, that is only going to increase the price of the houses in Jacksonville.
Yeah.
I don't think it's even what Irvi was talking about the supply chain. When the supply chain issue hit, the prices of the houses went up, but it never went down.
True.
It just stayed there.
Yeah. Right. That's when it just abated, right? And so that when you wonder, well, it's because Greg always is showing those charts in regards to price appreciation on homes in Jacksonville and so on and so forth, right? So there's going to always be a little bit of volatility, but when it's flat to low single digits, it's typically because of a supply demand issue, necessarily because of a recession. This chart showed what 8% average home price appreciation on across the board during recessionary periods.
So Pablo, how is the inventory looking with JWB now?
What do you mean?
I mean, you guys have houses in the inventory, or you guys are also in zero?
Yeah. No, I'm glad you asked. He also put a slide together of
nice.
inventory that's available. One of the things about the JWB inventory supply chain here is that they've really cracked that code, right? Like they're able to modulate because they know how to bring to market these like single family infill lots. Plus they have all the lines in the water to acquire. So right now there is inventory available for JWB, right? Like the minimum investment, it's kind of those price points that you're saying, Jade. They're somewhere in like the low 200s to mid 200s. So you're looking at somewhere around a 50K investment with closing costs and all that stuff. IRRs in like the 9 to 10s. Interest rates right now with buy downs and the deals that are happening are currently closing at 5.4, and they've got that the $12,000 of investment of incentives going on. So yeah, JWB does a really, really good job of keeping the inventory available based on market conditions because they have that super unique ability to bring new construction to market to fill in any gaps of existing inventory at any moment, and they have the best purchasing power of anybody in the local Jacksonville market to begin with, right? So I feel like that's one of their unspoken superpowers that allowed them to service people during COVID when nobody had inventory and all those things.
Mhm.
Does that answer your question?
Yes, and actually it does help the incentive program, because that helps in the closing cost or the points you pay if you're taking DSCR loans.
Yeah, yeah, totally. So, I'm obviously doing a terrible job as a marketer, but like if you are listening to us here and it's either time for you to, get going so that next time you don't get caught like this, or you find yourself in a position of strength because you've been investing in real estate assets, calling JWB and taking advantage of like this inventory, these incentives. There is a call to action slide here. There we go. If you call, you can call JWB right now at 904-677-6777. You can just text and they'll figure it out with you at 904-293-0341. Michael Carpenter, who's asking for the slides, if you text that number 904-293-0341, we'll get you the slides. Or I had a buddy reach out to me earlier today saying, man, I saw your Facebook Live. I think I want to be investing in real estate right now. If you want to just get something on the calendar, if you go to chatwithjwb.com, you'll get a calendar link, you book a call. That's how you get started. That's the easiest way to get started. So thank you for prompting me into actually going into some kind of like sales motion here, guys. I might be the worst marketer in the world.
Yeah. Oh, no idea.
That being said, guys, man, this was a really good discussion, right? Like I feel like I want to do more of this stuff more often, and this idea of just bringing on community members who have been there and are doing it. I can't think of two better examples from like two different walks of life that have really you guys have really set yourself up for success. And it was because of brave decisions you made 8, 9 years ago, and it came with the fact that you had to, make a change and not just do what you were doing before. Hervé, you from Wall Street, Jay, you in the IT sector, and kind of like diversifying, and it's led to being in these positions of power. I feel like I'm early in my journey and I've only been doing it for like 4 years, but I feel a sense of like empowerment in where I'm at. But to think that in 5, 7 years, when I'm in it as long as you guys, I'm going to be in that position is really, really awesome. So I just really appreciate the conversation. I appreciate the community being here, asking great questions as always, taking an hour of your day during the middle of a work week never goes unnoticed. But I kind of leave it with you guys for final thoughts on kind of like what your next moves are and any lessons moving forward here. I'll kick it to Jay first if you want to give us some kind of final thoughts here.
Yeah, the only thing, which I've been saying it to myself, I could have done it earlier. And then I realized, today is the day. So, and that's how I reached where I am today. So I would encourage everybody, there's never a bad time, to buy real estate because, any time, because there were people who said, oh, if I had bought this house for 15 years ago, I would have bought it for $35,000. Well, if you pay $350,000 today, it's still going up. So it's never a bad time.
Love that. Hervé, what about you, bro?
Yeah, man, a little bit what I said before earlier, right? I mean, take advantage of what's happening with rates right now. Look at your portfolio in regards to where there are opportunities, right? The good thing is that our market has seen volatility before for all different kind of reasons. Things will find a way to settle here, but probably settle at lower levels. I mean, that's just kind of what happens, right? But let this be a reminder that if you have a predominantly stock portfolio, to diversify, diversify, diversify. There's no better time to start balancing that out with, an asset that is not tied to the volatility the stock market is as right now, right? And so luckily, guys partner in JWB, soup to nuts, being vertically integrated, and so on and so forth, right? And they got a used inventory of homes that you can purchase that is not going to be hit to what's going on with these tariffs and its impact on new home builds and so on and so forth, and things like that, right? So you can get in at a decent price and you can get in at a low rate. Great time to buy and just let it out. And knowing that they've seemed to have put the brakes on increasing supply, we should start seeing some nice appreciation on our homes over the next couple of years.
Amen, my friend. I know I'm looking to buy right now. Next week, The show is going to be all about Greg uncovered a new strategy. This idea that, most folks, when you're thinking about cash flow, you're thinking about cash flow, going into the market and you're comparing it apples to apples day one. But when you think about cash flow outcomes, you want to think about, when will the cash flow be better for you, right? So we're doing this like 5-year case study of maximizing 5-year cash flow, not even 20-year, not 30-year, maximizing 5-year cash flow. Greg's got a whole new formula he's going to share on that. It's going to be awesome on Tuesday. I want to give a shout out to my alma mater, the Florida Gators, taking home the championship. Thank you very
And
much.
UConn.
And you guys who have family in UConn,
UConn.
right? The ladies national championship, the men's national championship. We call this championship circle here.
Yes.
on
Yes.
on the Natural Average Investor Show. Ray, are you trying to say something?
Now it's a very timely for us to be on Championship Circle, right?
Championship Circle. Championship Circle. Good to be here with a bunch of champions. So go Gators, go Huskies. And from here till next week. Any final piece of advice before we log off here, guys?
Don't be